Welcome to our video on the top 5 investing mistakes to avoid. Investing can be a powerful way to grow your wealth and achieve financial goals, but it's not without its risks. In this video, we'll be discussing some common mistakes that investors make and how to avoid them. Whether you're new to investing or an experienced investor, it's important to be aware of these pitfalls and make sure you're taking the right steps to set yourself up for success. So let's get started. In this segment, we'll be discussing the first mistake on our list, not having a plan or strategy. One of the biggest mistakes that investors make is not having a clear plan or strategy in place. Without a plan, it's easy to get caught up in the excitement of potential returns and make impulsive, poorly thought-out investment decisions. Having a plan helps you to stay focused and avoid getting swayed by short-term market fluctuations or the opinions of others. So, what should a good investment plan include? At a minimum, it should outline your financial goals, risk tolerance, and time horizon. It should also include a diversified portfolio that is appropriate for your goals and risk profile. And it's important to regularly review and adjust your plan as your financial situation and goals change. Not having a plan can lead to a number of problems. For example, you might end up with a portfolio that is too risky or too conservative for your needs, or you might miss out on opportunities because you don't have a clear strategy for identifying and evaluating potential investments. To avoid this mistake, take the time to develop a thoughtful investment plan that is tailored to your unique financial situation. And don't be afraid to seek the help of a financial advisor or professional if you need guidance. A little bit of planning and preparation can go a long way in helping you achieve your investment goals. In this segment, we'll be talking about mistake number 2. Chasing returns or trying to time the market. One of the biggest temptations for investors is to try to chase after high returns or predict market movements. It can be tempting to try to jump in and out of the market based on the latest headlines or market trends. But this approach is often a recipe for disaster. Trying to time the market or chase returns is a risky strategy that can result in missed opportunities or significant losses. The stock market is inherently unpredictable, and it's virtually impossible to consistently predict its movements. A better approach is to adopt a long-term, diversified investment strategy. This means investing in a variety of assets across different sectors and regions, with the goal of minimizing risk and maximizing potential returns over the long run. Diversification doesn't guarantee profits, but it can help to smooth out the ups and downs of the market and reduce the impact of any one investment on your overall portfolio. So, how can you avoid the mistake of chasing returns or trying to time the market? One key is to have patience and discipline. Don't try to chase after short-term gains. Instead, focus on building a well-diversified portfolio and sticking with it over the long run. And resist the temptation to make knee-jerk reactions based on the latest market news or trends. In the last 2 segments, we talked about the importance of having a clear investment plan and avoiding the temptation to chase returns or try to time the market. In this segment, we'll be discussing mistake number 3, not diversifying your portfolio. One of the most basic principles of investing is diversification, or the idea of spreading your risk across a variety of investments. Diversification can help to minimize the impact of any one investment on your overall portfolio, which can be especially important in times of market volatility. But despite its importance, many investors make the mistake of not diversifying their portfolios adequately. This can be especially tempting for those who are attracted to a particular asset or sector and want to put a large portion of their investments into it. However, this approach carries significant risks. By not diversifying, you're essentially putting all your eggs in one basket, which leaves you vulnerable to significant losses if that particular asset or sector doesn't perform as expected. So, how can you avoid this mistake? One key is to make sure you have a diverse mix of assets in your portfolio. This might include stocks, bonds, cash, and other assets such as real estate or commodities. It's also important to consider factors such as your risk tolerance, time horizon, and financial goals when building a diversified portfolio. To sum up, not diversifying your portfolio is a common investing mistake that can leave you vulnerable to significant losses. To avoid this mistake, make sure you have a diverse mix of assets in your portfolio and consider factors such as your risk tolerance and financial goals when building it. In the last 3 segments, we've discussed the importance of having a clear investment plan, avoiding the temptation to chase returns or try to time the market, and diversifying your portfolio. In this segment, we'll be talking about mistake number 4, not regularly reviewing and adjusting your portfolio. One of the keys to successful investing is regularly monitoring and reviewing your portfolio to make sure it's still aligned with your financial goals and risk tolerance. But many investors make the mistake of not doing this regularly, or at all. Not reviewing your portfolio regularly can lead to a number of problems. For example, you might miss out on opportunities to sell losing investments or to rebalance your portfolio to bring it back into alignment with your financial goals. Or, you might continue to hold onto investments that are no longer appropriate for your portfolio. So, how can you avoid this mistake? One key is to set a regular schedule for reviewing your portfolio, such as quarterly or annually. This will give you a chance to assess how your investments are performing and make any necessary adjustments. When reviewing your portfolio, consider factors such as your financial goals, risk tolerance, and time horizon. Make sure that your portfolio is still appropriate for your needs, and make adjustments as needed. To sum up, not regularly reviewing and adjusting your portfolio is a common investing mistake that can lead to missed opportunities or holding onto inappropriate investments. To avoid this mistake, set a regular schedule for reviewing your portfolio and make adjustments as needed to ensure it's aligned with your financial goals and risk tolerance. In this final segment, we'll be discussing mistake number 5, ignoring fees and taxes. Fees and taxes can have a significant impact on your investment returns, and yet many investors make the mistake of ignoring them or not fully understanding them. There are a number of types of fees that investors may encounter, including brokerage fees, mutual fund fees, and management fees. These fees can eat into your returns and reduce your overall investment performance. Similarly, taxes can also take a bite out of your investment returns, depending on the types of investments you hold and your tax bracket. So, how can you avoid this mistake? One key is to be aware of the fees and taxes that you're paying and to try to minimize them where possible. For example, you might choose low-cost index funds or ETFs to reduce mutual fund fees, or you might consider tax-efficient investments such as municipal bonds or index funds held in a tax-advantaged account. It's also important to understand the tax implications of your investments and to plan accordingly. For example, you might want to consider tax loss harvesting or charitable giving strategies to minimize your tax bill. To sum up, ignoring fees and taxes is a common investing mistake that can significantly reduce your investment returns. To avoid this mistake, be aware of the fees and taxes you're paying and try to minimize them where possible. And don't forget to consider the tax implications of your investments and plan accordingly. That concludes our video on the top 5 investing mistakes to avoid. We hope that these tips will help you to make more informed, successful investment decisions. By avoiding these mistakes and being mindful of the importance of careful planning and due diligence, you can set yourself up for success in your investing endeavors. Thank you again for watching, and best of luck in your investments.